Last week, silver prices plunged 22% to the $95 level. The headlines called it a shock, a sudden and aggressive crash. But was it really a surprise? For anyone watching the market's internal structure, this wasn't just predictable, it was inevitable. This wasn't a random event, it was the final violent resolution of pressures that had been building for months. See, markets don't just collapse out of nowhere. A move of this magnitude is always preceded by signals hiding just beneath the surface. It's a story of imbalance. In silver's case, the pressure points were clear. Massive leverage, thinning liquidity, and dangerously lopsided positioning. The crash to $95 wasn't a prediction. It was simply the point where the entire fragile structure was mathematically guaranteed to break. Silver is a fascinating asset. It's an industrial metal, a form of money, and a playground for speculators, all at once. This triple identity creates constant tension. And when that tension snaps, price stops being about fair value and becomes all about release. That's what we just witnessed. The defining feature wasn't the speed of the fall, but its certainty. Before the collapse, the price was held up by wishful thinking. Paper demand for silver was far outpacing the actual physical supply. Leverage was piling up much faster than the real money available to back it. Risk was being ignored while everyone stared at the stable price. But these conditions can't last. They don't resolve with a gentle correction, they resolve with a crash. And the precision of that crash is telling. Why exactly $95? Markets driven by physical supply and demand move in broad, messy ranges. But markets driven by derivatives, leverage, and margin calls, they move in sharp, precise steps. The $95 level was the magic number, the convergence point where margin requirements, technical triggers, and a lack of buyers all met. Once that level was hit, a cascade of forced selling was locked in. Let's be clear. This collapse says nothing about the long-term value of silver. It says everything about the broken mechanism we use to price it. The price didn't fall because silver suddenly became worthless. It fell because the paper market built on top of it could no longer support its own weight. That is a critical distinction for any serious investor. The warning signs were all there. Open interest was stubbornly high even as real trading volume dried up. Volatility indicators were flashing red, signaling distress while the price sat still. Most importantly, the cost to fund these speculative positions was rising sharply. When you see these signals align, a crash stops being a question of if and becomes a question of when. So why did so many call it unexpected? It reveals a common mistake in how people read markets. They watch the price for information. But by the time the price moves, the real story is already over. The real information lies in the structure, the leverage, and the constraints that force the price to move. The price is just the final confirmation. The silver crash is a powerful lesson. It exposes the fragility of any system built on too much debt and blind faith in liquidity. It shows the danger of surface-level analysis. When someone says a market move was unpredictable, what they often mean is that it was inconvenient for their own beliefs and positions. This isn't just about silver. This is about how all markets behave under stress. Whether it's stocks, crypto, or commodities, the principles are the same. Understanding where pressure builds and where it must be released is the key. So the crash was not a random black swan event. It was a structural outcome. The real question isn't why it happened, but why so many were caught completely off guard, positioned for a reality that simply couldn't last. Now, to truly understand what comes next, we have to look deeper, beneath the headlines and into the hidden mechanics of how the silver market truly operates. Ever wondered why the price of that silver coin you own seems to have a mind of its own? It's not just about simple supply and demand. The silver market is a fascinating, complex world, and today we're pulling back the curtain to see how it really works. Let's start with a concept that might surprise you. Paper silver. Most silver trading doesn't involve moving physical metal at all. Instead, it happens through contracts, ETFs, and other financial instruments collectively known as paper silver. Think of it like this. For every single physical ounce of silver sitting in a vault, there can be hundreds of paper claims trading on the open market. This creates a massive disconnect. When you buy a silver ETF, you're not buying the metal itself, but a share in a fund that supposedly holds the metal. These paper markets are what primarily determine the daily spot price of silver. This is crucial because it means the price you see on your screen is influenced more by financial trading than by the number of silver eagles being minted or used in solar panels. Now, let's add another layer of complexity. Leverage. This is where things get really interesting. In financial markets, leverage allows traders to control a large amount of a commodity with a very small amount of their own money. For instance, on the COMEX exchange, a trader might only need to put down about 5% of the total value of a silver futures contract. So if everyone decided to cash in their paper silver for physical metal, would there be enough to go around? That brings us to liquidity. The paper silver market is incredibly liquid, meaning it's easy to buy and sell large volumes without significantly affecting the price. Billions of dollars in paper silver can change hands every single day. This is a good thing for traders who need to get in and out of positions quickly. However, the physical market is a different story. It's much less liquid. If a large number of investors suddenly demanded physical delivery of their silver, it could create a massive shortage, a situation known as a squeeze. The system relies on the assumption that most people will never actually ask for the real metal. The vast liquidity in the paper market masks the much tighter reality of the physical market. The final piece of this puzzle is modern technology, specifically algorithmic trading. High-frequency trading firms use powerful computers and complex algorithms to execute millions of trades in fractions of a second. These algos are not analyzing industrial demand or mining output. They're programmed to react to price patterns, news headlines, and other market data at lightning speed. They can create selling or buying pressure in an instant, often triggering stop-loss orders and causing cascading price movements. This algorithmic trading now dominates the market, adding another layer of volatility and making it even more detached from the physical world. It's a game of speed and code, where human decision-making is often left in the dust. So, when you look at the price of silver, remember what you're really seeing. It's the result of a complex dance between a vast ocean of paper contracts, the amplifying power of leverage, the illusion of endless liquidity, and the lightning-fast decisions of trading algorithms. The physical metal is just a small part of this giant financial machine. Understanding these mechanisms is key to navigating the wild and wonderful world of silver. Thanks for watching. If you found this breakdown helpful, be sure to hit that like button and subscribe for more deep dives into the financial markets. See you next time. Have you ever wondered what makes the price of silver jump up and down so much? It's not just about how much is mined or how many rings are sold. A huge part of the story is the global economy, and today we're diving deep into exactly how that works. Let's start with a big one: inflation. When the cost of living goes up and your money buys less than it used to, investors often look for a safe place to park their wealth. Silver, just like gold, has been seen for centuries as a store of value. So, when inflation rears its head, demand for silver can rise, pushing its price up. It's like an economic shield for your savings. Now, let's talk about interest rates. This is a bit of a tug of war. When central banks, like the US Federal Reserve, raise interest rates, it makes saving money in a bank account more attractive because you earn more interest. This can make holding silver, which doesn't pay you any interest, seem less appealing. So higher interest rates can sometimes put downward pressure on silver prices. On the other hand, when interest rates are low, holding silver becomes a more attractive option compared to low-yielding savings accounts. It's all about what gives you the better return. Next up is the US dollar. Since silver is priced in US dollars all around the world, the strength of the dollar has a massive impact. Think of it like a seesaw. When the dollar gets stronger, it takes fewer dollars to buy an ounce of silver. For investors holding other currencies, silver becomes more expensive, which can reduce demand and lower the price. Conversely, when the dollar is weak, silver becomes cheaper for foreign buyers, which can boost demand and send the price higher. So if you're watching silver, you absolutely have to watch the dollar. Finally, we can't ignore geopolitical instability. When there's conflict, trade disputes, or political uncertainty somewhere in the world, investors get nervous. They start looking for safe haven assets, things that hold their value when traditional markets are shaky. Silver, with its long history as a reliable asset, often fits the bill perfectly. During times of global stress, we often see a flight to safety, with money pouring into precious metals like silver, which drives up its value. So, from inflation and interest rates to the dollar and global events, the silver market is a fascinating reflection of our world's economy. Understanding these factors can give you a much clearer picture of why silver prices move the way they do. It's a complex dance of global forces, but once you know the steps, it's much easier to follow along. The context. Macro pressures. Converging on silver, while the internal mechanics of the silver market explain how the collapse unfolded, they do not fully explain why it occurred at this specific moment. Structural fragilities can persist for extended periods without resolution. What converts fragility into failure is context. In this case, a convergence of macroeconomic pressures compressed the system until release became unavoidable. The first of these pressures was tightening financial conditions. As global funding costs increased, leverage became more expensive to maintain. This shift disproportionately affected markets where positions were carried with thin margins and high notional exposure. Silver fit this profile precisely. Participants who had previously tolerated volatility in exchange for cheap financing were forced to reassess risk as capital costs rose. Higher funding costs alter behavior in subtle but powerful ways. They reduce the time horizon over which positions can be held. They increase sensitivity to drawdowns. They incentivize deleveraging even in the absence of a directional thesis. In such an environment, markets with embedded leverage become early candidates for stress events, Currency dynamics added another layer of pressure. Periods of currency instability tend to reshuffle hedging behavior across asset classes. When confidence in monetary stability weakens, capital seeks protection. However, that protection is not distributed evenly. Gold, with its deeper liquidity and central bank backing, often absorbs monetary hedging demand more effectively than silver. Silver, by contrast, is left exposed to its speculative and industrial components. This divergence matters. As macro uncertainty rises, correlations that normally support silver can break down. Investors seeking safety consolidate into assets perceived as more stable. Those seeking liquidity reduce exposure to assets with higher volatility in thinner markets. Silver, straddling both categories imperfectly, becomes vulnerable to abandonment at precisely the wrong moment. Industrial demand uncertainty further complicated the landscape. Slowing growth expectations and uneven manufacturing signals introduced ambiguity into silver's demand outlook. While long-term industrial use remained intact, short-term visibility deteriorated. Markets rarely price long-term fundamentals during periods of stress. They price near-term risk. This bias contributed to the willingness to liquidate. Geopolitical factors also played a role, not through direct causation, but through risk recalibration. Heightened geopolitical tension tends to increase volatility across commodities and currencies. In response, institutional portfolios often reduce exposure to assets that amplify overall portfolio risk. Silver's volatility profile makes it a frequent candidate for such reductions. Crucially, these macro pressures did not need to be extreme. They needed only to be sufficient to tip a fragile structure. The silver market was already operating near its tolerance threshold. Incremental increases in stress were enough to trigger a nonlinear response. This is characteristic of systems that appear stable until they are not. Another contextual factor was timing. Market stress rarely manifests simultaneously across all assets. It migrates. Weakness appears first where constraints are tightest and flexibility is lowest. Silver's combination of leverage, liquidity limitations, and mixed identity made it an early release valve. Its decline should therefore be interpreted as a signal rather than an anomaly. This perspective challenges the tendency to isolate events. When silver collapsed, the immediate focus was on silver itself. The more relevant question is what the event reveals about broader conditions. Assets that fail first often do so because they are closest to the edge. Their failure indicates proximity to systemic boundaries elsewhere. For decision makers, this context is critical. It suggests that the silver collapse was not an isolated mispricing, but part of a broader pattern of stress transmission. Markets under macro pressure do not adjust uniformly. They fracture along lines of structural weakness. Observing where those fractures occur provides valuable information. The alignment of tightening financial conditions, shifting currency dynamics, industrial uncertainty, and geopolitical risk created an environment in which silver's internal fragilities could no longer be deferred. The precise timing of the collapse reflects the moment these forces intersected, not a sudden change in sentiment. Understanding this convergence reframes the event yet again. The decline was not simply about silver, it was about the interaction between market structure and macro context. When those two dimensions align negatively, outcomes become compressed and decisive. With this broader framework established, the analysis must now turn toward implications. If silver functioned as an early warning indicator, the critical question becomes what this signal means for capital allocation, risk management, and strategic decision-making moving forward. That examination follows next. The implications. Strategic signals for serious capital. The collapse of silver to the 95 level should be interpreted not as an endpoint, but as an informational event. Its significance lies less in the magnitude of the move than in what the move reveals about the condition of the system that produced it. For decision makers responsible for allocating capital, managing enterprises, or assessing macro risk, the implications extend well beyond the silver market itself. The first implication concerns structural fragility. When an asset reprices with precision after prolonged stability, it indicates that the system governing its valuation was operating near its limits. Such systems often appear resilient until they are forced to reconcile accumulated stress. The silver collapse demonstrates how quickly confidence and stability can evaporate once constraints are breached. This has direct relevance for any market characterized by leverage and thin liquidity. Precision in downside moves is not a sign of control, it is a sign of compression. It suggests that risk was not being dispersed gradually, but stored. When release occurs, it does so abruptly. For capital stewards, this underscores the importance of identifying where risk is being warehoused, rather than where it is visible. A second implication is the divergence between price signals and underlying realities. In the silver market, paper liquidation occurred alongside continued interest in physical accumulation. This divergence highlights a recurring feature of modern markets. Financial instruments often transmit stress faster than the assets they reference. Price declines may therefore reflect balance sheet behavior rather than fundamental reassessment. For entrepreneurs and business leaders, this distinction matters. Price volatility in indicator assets can serve as an early warning of tightening conditions elsewhere. When financial markets are forced to deleverage, access to credit, funding terms, and risk appetite can change rapidly. Monitoring these signals is not about trading. It is about anticipating shifts in the operating environment. Another implication involves narrative risk. Markets often rely on simplified explanations to maintain confidence. When those narratives fail, reactions can be disproportionate. The surprise expressed after the silver collapse suggests that many participants were anchored to assumptions that no longer held. In such situations, the risk lies not in volatility itself, but in the speed at which assumptions must be revised. The event also illustrates the asymmetry of risk in stressed systems. Upside is often gradual and contested, while downside is swift and decisive. This asymmetry should inform strategic planning. Enterprises exposed to volatile input costs, funding dependencies, or currency risk should account for the possibility that adjustments will not occur smoothly. Importantly, the silver collapse does not provide a prescription. It does not indicate what assets to buy or sell. Its value lies in diagnosis. It reveals how systems behave when margins are thin and confidence is conditional. For serious capital, the lesson is to focus less on forecasts and more on resilience. Resilience, in this context, means understanding capital structure, liquidity access, and exposure to external shocks. It means stress testing assumptions under scenarios of rapid repricing. It means recognizing that stability in quoted prices does not guarantee stability in underlying systems. There's also a temporal implication. Events like this tend to occur in clusters rather than isolation. Once one market is forced to adjust, pressure often migrates. This does not imply imminent collapse elsewhere, but it does suggest heightened sensitivity. Periods following such events warrant increased attention to indicators that measure strain rather than performance. For those building or managing businesses, the broader message is cautionary. Financial markets influence real economic conditions through credit availability, confidence, and cost of capital. Signals of stress in one domain can precede constraints in another. Interpreting these signals early allows for strategic adjustment rather than reactive response. Finally, the precision of the silver collapse challenges the notion that markets are purely reactive. It reinforces the view that outcomes are often determined by structure long before they become visible. Recognizing this shifts focus from reacting to price to understanding systems. As an analytical warning, the event serves its purpose. It demonstrates how quickly conditions can change when structural limits are reached. It invites decision makers to reassess where similar limits may exist within their own exposures. What follows from this point is not speculation, but consequence. When systems built on leverage and confidence are forced to adjust, the effects extend beyond a single asset. Understanding those longer-term consequences requires a broader synthesis, one that considers how repeated structural signals reshape markets over time. That synthesis concludes the analysis